We are going to be talking about the electrifying topic of fund formation, structuring, and compensation at the fund manager level. That's my part of it. And Dan's part of it is going to relate to probably the topic that most of the audience will be more interested in, and that has to do with generational wealth planning for fund managers and family offices, which is obviously very pertinent right now with a lot of people thinking about how the tax laws might change. This isn't really a panel. This is more of a presentation. I'm going to spend about half of it talking about the structuring aspects, and Dan will take the last half of it. And after the panel that we just listened to, which was really fascinating, I do have a bit of concern that some of the structuring stuff might be a little dry to finish off the day. So I'll try to keep it light and interesting. Talking about blockers and U.S. tax exempt investors in different jurisdictions is electrifying to some, but perhaps not all, although it's a useful thing to talk about. And if anybody has any questions, I noticed in my first panel this morning that I looked a little bit late at the chat, and I'd love to make this interactive. Use the opportunity to ask your structuring questions to me. I'll give you just a little bit about my personal background because I gave the firm background this morning at 9 o'clock when I did the introduction remarks, and I spoke about my first panel, which is private equity trends in 2021. So instead of talking about the firm, I'll talk a little bit about my background to enable people to ask questions that might be relevant. I started at another law firm back in 2004 doing general corporate work and some fund formation work. Realized that I really, really enjoyed doing the fund formation and the regulatory aspects that relate to investment managers, both from the SEC and the CFTC, and even extra jurisdictional stuff. For example, AFMD in recent years, MiFID, European regulations, I find very interesting. And there's plenty of work to do figuring out how to advise my clients, both in the US and outside the US, how to structure their investment products to be compliant and as a priority, and as potentially a more important priority, that they are ripe for investment by all different types of investors who want to participate in their products and have their own criteria for doing so. So after a couple of years of doing that, realizing that I really wanted to focus in the fund space, I moved to another law firm that had a more extensive background in fund formation, both on the hedge fund and private equity side, and spent the next 6 years there learning a lot about different types of fund strategies, really forming funds within every strategy that you could imagine, from global macro, long short equity, private equity, real estate, emerging managers, really alternative assets. Like I even worked on a wine fund once. Now I'm actually working on a trading card fund, an NFT fund, which is completely fascinating. It's such a great asset class right now that there are actually people raising capital to buy and sell sports cards, if you wouldn't believe that. But I am raising a fund with a client in that space right now. So really every strategy across the board, nothing too big, nothing too small. And it's been a really rewarding practice for me. I went in-house after 6 years at the other firm to start a platform called HedgeMark, which was a managed account platform for institutional investors. I went there when they had zero assets on their platform. We were acquired by BNY Mellon in 2014 and ended up growing the platform to a little over $27 billion before I left at the end of last summer, which was a pretty remarkable accomplishment. And along the way, I must have structured, several hundred, if not 1,000 funds. So again, just a lot of experience with all different structuring types of questions for all different classes of investors and all different investment strategies. So, with that introduction, if there are specific questions about things that you always wanted to ask but were embarrassed to, go ahead and put them in the chat, and I'll try to answer them as best I can. Just general stuff about, and I came to Morrison Cohen in August of last year to really just try to build out and expand upon our existing fund formation practice, and was ready for a new challenge in doing that. It's been a great experience so far. Dan will talk a little bit more about the firm before he starts, because I don't want to be repetitive and say exactly what I said this morning. But we have a great practice that's collaborative with other practice areas within the firm, and can really provide a full service solution to managers that are looking to start their own funds, but also, as I'll discuss a little bit, who are looking to find ways to incentivize employees, bring on new employees, and we can do their underlying deal work for private equity strategies. And then notably, a lot of people seem very interested in the blockchain space and DeFi on the last panel. I certainly am. I certainly have a lot of clients coming to me right now and talking about how to raise capital to invest in those areas. We also have a lot of clients who are trying to start new products within the blockchain space, not necessarily fund related, but I do have a partner who's a real expert in that area. And if you wanted to meet him, I'd be happy to make introductions. He keeps a tracker of every single regulatory proceeding or litigation against people in the blockchain or DeFi space. And he's the guy you want to call if you've gotten into some sort of issue with blockchain. But I've been trying to put him out there as the guy who's going to tell you how to structure these products without getting into trouble to begin with. And he's really very good at it. His name is Jason Gottlieb. And we're trying to do a lot of work together right now, synergizing fund formation plus and providing the expertise on the actual fund formation process and giving advice with respect to the underlying assets. So this is great. I see a couple of questions. Many people are moving to venture capital, even hedge funds. What issues should people consider as they create a VC fund? So I'm not sure if there are really a lot of different issues in terms of creating VC funds. They do have some different terms than what you're used to in the more traditional private equity space. For example, on the compensation side, in the VC space, a lot of times you'll see just a straight return of capital and then 80-20% split between the manager and the investors. Whereas in the private equity space, it's much more common to see a hurdle, a preferred return that the investors will achieve before the manager starts getting paid. The reason for that is really because of the upside, I think, in the VC space. It's a little bit more of a home run or bust type of area, and the pref is really not as meaningful when you're talking about making some crazy multiples on some investments, 3x, 7x, 13x, like we heard on the last call. Versus private equity, which is still hopefully very lucrative, but maybe not quite as high as those returns. So the preferred return isn't meaningful. The other things in venture capital, there's also this weird concept of having multiple closings without investors that come in later subsidizing the risk, paying an interest charge. Therefore, the first investors will subsidize the risk of the new investors. And in private equity funds, that doesn't happen. It's always something I found a bit curious. Interesting issues in VC, if we're really talking about issues and things to worry about as a VC manager, a lot of times you'll see VC managers warehouse investments because they have access to them before they're capable of raising a fund. And of course, in the VC space, because they are angel investors and the valuations could fluctuate fairly widely before there's some sort of a realization. There are some ripe conflict issues there to think about in terms of how you get the assets from the fund, from the warehouse facility into the fund. And that's actually a very good segue to the next question. But those are the types of things that I would want to think through with clients. There's some sort of a balance if they've held it for a while between charging cost for the investment when there was real risk in the warehouse facility that the manager took on. But of course, there's a major conflict of interest with the manager potentially overcharging the fund. So, that's something I think about. The next question has to do with multiple strategies versus individual strategies. It's the same sort of concept. If you have multiple strategies, as a fund manager, you really want to be thinking about what types of conflicts can arise by virtue of having multiple strategies within the same house. Do they conflict with each other? Does one take away from the other? Are you investing in different parts of a capital structure of the same issuer because the one strategy is a mezz debt strategy and the other is a long short equity strategy, and how might they affect each other in different situations? So sort of the same answer for the two questions, VC versus multi-strat in terms of conflicts. Next question, what about master feeder funds? What are the considerations? So I was going to talk a little bit about master feeder funds anyway, so that's a good space. Why do people do master feeder funds? The reason for it is really to ensure that you can take in capital from different classes of investors in an efficient way from their perspective in terms of taxes, and have one aggregating vehicle so that the manager doesn't have to trade on a side-by-side basis. It's a bit of a pain to have two funds that are doing things side by side, separate accounts, separate documents, etc. So what the master feeder fund allows you to do is take in, from a U.S. perspective, U.S. taxable investors through a pass-through vehicle. It's a partnership. So U.S. taxable investors don't want to have any sort of tax leakage by investing through a corporation. And U.S. taxable investors generally prefer not to invest through an offshore entity. So it's the most efficient way for them to invest in a fund. They just get a K-1 at the end of the year and they send it to their accountant, and that's how they deal with their taxes. With tax-exempt investors, there's this concept of unrelated business taxable income. And that's where, if your tax-exempt purpose is to simply make investments, for example, so you're allowed to hold shares and have appreciation or dividends or income off of those shares. If you invest through a partnership in certain strategies, like for example, if there's a strategy that does direct lending, you're no longer necessarily in an investing business. You're actually in a lending business. And because of that, you're not acting solely in accordance with your tax-exempt purpose. You might be subject to tax on the lending income. So therefore, you set up what's called a blocker corporation. That's typically an offshore corporation in a jurisdiction like the Cayman Islands, which is tax-free. So you're not worried about a second level of taxation, which would happen with the U.S. corporation. In the Cayman, you have the corporation. The corporation is not subject to tax, and then the only asset that the tax-exempt plan owns is shares in a corporation. So therefore, you block any unrelated business taxable income, and it gets rid of that issue for them. And then similarly for non-U.S. investors, I know it's probably not that relevant to the crowd in the family office space here, but if you have non-U.S. investors that really want nothing to do with U.S. source income, they also prefer to go through that blocker corporation because it prevents them from having to file tax returns in the U.S. So next question, and I do want to turn it over to Dan because I know we're short on time, and Dan's presentation is way more interesting than mine. And he's also an Islander fan and I'm a Ranger fan. So you're going to get some of that positive energy coming off of that monumentous overtime win last night to send the Islanders to Game 7 of the Eastern Conference Finals. Very remarkable. Dan, look at that smile on his face. So due diligence for family offices, do I review LP contracts or are they cookie cutter? The answer is yes and yes. I will absolutely help review investments in fund products for family offices. I will review contracts that they're entering into with fund managers for fund investments, for co-investments, etc. So I will go ahead and put my bio in the panel here, and if you have those types of needs, I'll be very pleased to speak to anybody in the audience. And then the last question I see, momentum plays. Any thoughts on how to be an LP in opportunities that are more short-term or ephemeral in nature, 3 and 30 digital asset funds? It's a pretty general question. It's a good question. I don't have any specific thoughts on how to be an LP in those opportunities from a legal perspective. It's really an investment perspective question. My answer to you as somebody that deals with a lot of investors all the time is, if the price is right and it's a compelling opportunity, very similar to what some of the presenters on the last panel were talking about, if the net returns are good, then don't worry about the 3 and 30. Invest in the product, because the digital asset funds, like was discussed on the last panel, there aren't that many of them yet. And I think about this from a personal perspective, because really, if you talk to your friends about investing in crypto, for example, sure, you could go and get a Coinbase account and buy and sell Bitcoin and Ether, but that's essentially, I hate to put it this way, but it's gambling from an individual perspective. You might have some sort of insight as to where Bitcoin's going to go or where Ether is going to go, but we don't know, and it is a very opaque market, as liquid as it's getting. If you want real alpha in the space, there are managers out there that really, really know what they're doing right now. I have clients that are asking for introductions. So to the extent you want to talk about that, I'm happy to take calls about it and try to make some connections for people. That's something that we as a firm, Morrison Cohen, take a lot of pride in, introducing our contacts to one another. It's a sort of a new marketing thing for us. We call it the power of end. We always try to do more than just be legal advisors to our clients. So I'm definitely happy to make those introductions, and I'm definitely happy to talk about the digital asset space because I'm fascinated by it right now, and it's only going to grow, and you're going to see a very big separation between quality products and the things that everybody's sort of making fun of in the press right now. So with that, I'm going to turn it over to this very happy Islanders fan and let you guys think a little bit about how you're going to deal with your estate planning before there are some massive changes. Dan, please.
Thanks a lot, Brian. Sorry for your Rangers season this year, but there's always next year. So good evening, everyone. My name is Daniel Student. I'm a trust and estates attorney and a member of the individual clients group and family office group here at Morrison Cohen in New York. We're a sophisticated and, in the New York market, relatively lean shop of over about 100 lawyers focused on a wide range of practice areas, and we pride ourselves on our client relationships and delivering tangible value. My practice focuses on representing individuals and families, family offices, and their fiduciaries in a wide array of estate planning and administration matters, including family and charitable planning and contested and uncontested trust and estates matters. Most relevant to the panel today, my practice includes working closely with our stellar investment fund group here at Morrison Cohen, including my co-panelist, Brian, on personal planning matters for fund principals, including implementing and administering tax minimization strategies for our fund principal clients. I'd like to take most of my time here today to discuss where we are from a federal wealth transfer tax perspective and what could be done now to secure benefits that might not be here tomorrow. Essentially, for many of our clients, moving estate planning matters to the front burner before doors on certain strategies potentially close. At current, we're enjoying historically high federal wealth transfer tax exemptions under current rules, which were enacted under the 2017 Tax Cuts and Jobs Act. U.S. persons, which for this purpose means U.S. citizens or U.S. residents, can transfer up to $11.7 million per person or $23.4 million per married couple to family members or other private beneficiaries without incurring a gift, estate, or generation skipping transfer tax. Therefore, under current rules, significant gift transfers can be made to estate protected vehicles for G2 or younger, and these vehicles can then invest funds or purchase assets from senior generation family members to build wealth on a tax preferred basis. What makes 2021 particularly unique is the current political climate and the resulting prospect for significant tax legislation to reduce or eliminate the efficacy, or in some instances, the possibility of effectuating tax minimization strategies, which are key in the estate planner's toolkit. To date, The most wide sweeping proposal for changes that would significantly affect wealth transfer planning for US individuals is the 99.5% Act, which was introduced by Bernie Sanders at the end of March. The act includes a number of Green Book proposals from the Obama era and is very similar to Bernie Sanders' own 2019 proposed legislation, the 99.8% Act. Don't ask me what happened to the other 0.3% of Americans in the title. Among other things, the act as proposed would reduce the estate tax exemption for US persons to 3.5 million, the gift tax exemption all the way down to 1 million, raise the rates on wealth transfer taxes to up to 77% for assets over $1 billion, reduce the efficacy of valuation discounts in connection with intrafamily wealth transfers, eliminate minority discounts, reintroduce the so-called GRAT killer rules, which have been introduced several times over the years and if implemented as proposed would greatly reduce the efficacy of GRAT planning, and a series of other rules, including rules designed to limit the efficacy of long-term trusts, all effective as of the beginning of next year. The good news is that neither the administration's American Families Plan released in April, nor the resulting Green Book issued by the Treasury late last month included any reference to reduced wealth transfer tax exemptions. Instead, focusing on capital gains tax overhauls that have brought to the fore the prospect of recognizing gain in positions that are near to term, amongst other considerations, significant considerations. Included in the plan are the sweeping proposals to tax capital gain, including carried interest income at normal rates for high income taxpayers, and deemed realization provisions for estate and gift transfers, eliminating for most taxpayers the benefit of an adjusted tax cost basis for property passing through an estate, and also included other very significant deemed realization rules that would affect trust property. Given the number and extent of the proposals currently circulating, the foregoing only being a portion of them, as well as the current makeup of the houses of Congress and the likely need to rely on budget reconciliation and votes around the margin, and a certain degree of likely horse trading to pass any substantial tax legislation, the prospects for any of these proposals to pass as proposed is far from certain. So while it's too early to make predictions, it's not too early to make moves to secure current benefits that might not be sticking around. The primary objective from a wealth transfer tax perspective in 2021 is going to be to seek to utilize any remaining gift tax exemption while those amounts are still in play. It's important to note that in the event no legislation regarding wealth transfer tax exemptions passes, the current exemptions sunset and disappear at the end of 2025, at which time they would revert to half their current levels. So just to take an example, even if no legislation is passed, a US citizen taxpayer who has made no gifts would on January 1, 2026, without further planning, lose the ability to protect from wealth transfer tax over $6 million of assets, which is over 12 million per married couple. It's also important to note, while my personal opinion is that it would be unlikely for several reasons, practical and otherwise, it's possible that changes to the wealth transfer tax exemptions would be made on a retroactive basis. There are ways to mitigate the effects of potential retroactivity, and some risks associated with certain of those minimization strategies that are more aggressive than others that must be considered in connection with any gift planning put in place in 2021. Fund principals can activate their capital and carry interests in funds through estate planning, utilizing gifts and or gifts coupled with sales of those interests to younger generation family members or estate protected trusts in order to utilize any remaining gift tax exemption and grow wealth outside the transfer tax net. Utilizing an estate protected trust as the gift recipient or sale recipient can enhance benefits both from a wealth transfer and from an income tax perspective, and provide enhanced retained control for a donor, and if married, potential access for the donor's spouse through a so-called SLAT, which could be used as a security blanket or an insurance policy in the event funds might be needed at a later date under changed circumstances. Zeroed out grats, under which the donor retains an annuity stream equal to what was put into the trust plus a very low hurdle rate, currently 1.2%, can be very powerful wealth transfer tax vehicles for carried interests, even when the fund principal has utilized his or her entire wealth transfer tax exemptions. When putting together a GRAT plan for a fund manager and deciding on the funding and timeline of the trust, one must always be mindful of capital commitments and the ability of the GRAT to fund them so that from a practical perspective, the GRAT can work as intended. When activating any wealth transfer plan concerning fund interests, one must be mindful of the special valuation rules that can apply to a donor who holds multiple interests in a fund, such as a capital and a carry interests that sit in different places in the distribution waterfall. In certain instances, such as when a principal is deemed to own and control the fund through an interest in the general partner, if care is not taken in connection with formulating the plan, the transfer can produce a large unintended deemed gift of interests that are actually retained by the donor, which would obviously not be a good result. Often, these issues are avoided by transferring a so-called vertical slice of each equity interest in the fund held by the donor or seller, as it were, or by utilizing a special purpose vehicle that contains provisions designed to thwart the undesirable rules. It bears noting that utilizing an SPV, even in connection with vertical slice planning, can be beneficial, as doing so can greatly reduce information that needs to be shared with the fund upon gift transfers, as well as paperwork, as the interests in the SPV can then be transferred to the recipients instead of individual fund interests. I want to thank I think we may be running out of time here, but I do want to thank the conference organizers for inviting me to speak with you today. And to those of you who listened along, please don't hesitate to contact me with any questions on the issues that we discussed today or any other issues that may be top of mind for you and your clients. My contact information should be up here somewhere, but if it's not, I can be reached at my telephone number and email at morrisoncohen.com. So I just want to thank you all for listening along, and thank IvyFON and my co-presenter, Brian, and have a great evening.
I see we got one more question, Marty, just about dual citizenship and protecting against U.S. taxes. I sent back an answer privately to the person who asked, but just the short answer is I don't think it does. It's probably very fact specific. Being a dual citizen in and of itself won't protect you from Uncle Sam, unfortunately. But if you do have specific tax questions, we have a tax group, and I'd be happy to put you in touch with someone that knows a lot more about the topic than I do. And I want to reiterate my appreciation to Marty and IvyFON. It was really just a great conference. I was able to listen to a lot of it today. Super fascinating panels, and you put together a great product, and I'm really, really honored and proud to be a part of it. So thanks a lot, Marty.
Yes, listen, guys, great job. And I just want to thank Morrison Cohen so much for allowing us to use the facility. We had some great speakers and great content, and can't thank you enough. So thanks so much again. And so just a quick reminder, we're going to be in Baltimore, August 12th, Silicon Valley, September 8th and 9th. And then we're back in New York on October 14th and 15th, I think. Miami Art Basel, November 29th and 30th. Los Angeles, December 15th and 16th. And then JP Morgan Healthcare Week in San Francisco, January 12th, 13th, 13th, 14th, something like that. So we're going to make it happen. And we look forward to seeing you again. We hit 450 people today. And we had about almost 200 downloads of the document. So thanks so much. Appreciate it. And you all have a great day. Thanks. Cheers.